Hello, everyone, and welcome back to the Deep Dive. We are really excited for the show today. It's one we think gives you the insights and hopefully the conviction you need to navigate some of the most complex businesses out there.
We really do. We have an exceptional deep dive plan today. It's a company that, is often held up as this gold standard of financial durability.
A fortress.
Exactly. But it's also, right now, engaged in what might be the most high-stakes structural gamble of its entire modern history.
That's right. Today, we are finally tearing down the analog powerhouse, Texas Instruments, ticker symbol TXN.
And the central conflict here, for any long-term investor, it's just massive. TI is currently enacting a policy of what you can only call extreme financial self-denial.
Right. They're committing upwards of $5 billion every single year.
$5 billion a year into these massive long-term manufacturing investments. It's a move that sacrifices short-term profitability for really generational scale.
So the critical question we have to answer is this. Is this extreme commitment building an absolutely unassailable fortress, a structural cost advantage that could guarantee decades of profit and market dominance? Or are they falling into what we call the dreaded Intel trap? Are they committing fully to the high capital-owned factory model, the IDM model, precisely at the moment when the rest of the semiconductor industry is sprinting towards capital-light third-party foundries?
And that is the whole story. That is the core conflict we are here to unpack today.
Wow. That cuts right to the heart of it, doesn't it? Capital intensity versus that long-term structural advantage.
It's a really nuanced argument. And before we dive into the analog world, just a quick note for everyone following along with us.
Yeah, absolutely. For those of you who want to act on these investment ideas, whether it's sizing up TXN or, moving into any other part of the market, having a professional-grade platform that can handle complex trades and analysis is key.
It really is.
We use Interactive Brokers, and we've partnered with them to get you a stock bonus when you sign up.
So you get a bonus to start your portfolio, and you support the deep research and analysis that makes this show possible all at the same time. That link is right there for you in the description.
It's the best way to support the engine that makes this research happen.
Right.
And of course, if you find value in this kind of in-depth discussion, the best way to ensure you catch the next one is to subscribe and like this content. It truly helps the channel.
And we love hearing from you.
We do. So if you have any questions or if you want to challenge our analysis on TXN, please manifest yourself in the comment section. We pay very, very close attention to those discussions.
Perfect. Now let's get into the structure. The Texas Instruments story is, it's not about revolutionary technology. It's not about the next big thing.
Wow.
It's about structural endurance and maximizing profitability over very long periods of time. So, pillar number one, the business and its competitive fortress, the analog endurance.
Okay, so let's unpack this business. When we talk about TI, we absolutely have to, divorce it from the flashier parts of the semiconductor market.
Yeah.
We are not discussing the bleeding-edge 3-nanometer digital chips that run your iPhone or train the latest generative AI models. That's a completely different universe.
Not at all. TI operates in a far more foundational and, frankly, a much, much more durable part of the entire ecosystem.
So where does that durability come from?
Well, that durability stems from their specialization, analog chips and embedded processors. To really appreciate the fortress, you have to first understand the fundamental role these chips play. Digital logic chips, the Intels, the NVIDIAs, they process the clean, discrete information of zeros and ones.
Pure math.
Pure math, exactly. But the world isn't made of zeros and ones. It's messy.
TI's analog chips are the absolutely essential translators in that messy world. They are the bridge between the noisy physical reality around us and that clean digital domain.
A great way to put it. Analog chips detect real-world continuous signals, things like temperature fluctuations in a factory, or the pressure being exerted by a robotic arm.
Or sound waves, light intensity, anything that isn't a simple on or off.
Precisely. And they translate those complex signals into the discrete digital data that the main processor can actually understand and use.
So as long as we have a physical world that we need to measure and interact with,
you need analog conversion. The model is exceptionally durable, it's non-volatile, and it is not subject to the rapid, brutal obsolescence cycles that plague the digital world.
And crucially, where they sell these chips matters just as much as what the chips actually do. Their focus is, it's laser targeted on what some people might call the boring sectors.
Right. Industrial applications and automotive.
And why is this so important? Because these are not the volatile consumer-driven markets like PCs or gaming consoles or smartphones, which
Yeah.
experience these massive boom and bust cycles.
No, industrial and automotive, these are the bedrock of the global economy.
That focus gives them a structural demand that is, to a large degree, insulated from consumer whims.
It does. I mean, consider the two great secular trends of this decade: factory automation and vehicle electrification. Every single new industrial robot, every modern machine tool, and certainly every electric vehicle.
They all require exponentially more analog content than the older models they're replacing.
Exactly. A high-end EV might contain 3 to 4 times the dollar content of TI chips compared to a traditional internal combustion engine vehicle.
So even if car sales are flat for a year,
It doesn't matter as much. This content growth is an inherent structural growth engine. It ensures expansion even if the total unit sales volumes stay flat.
okay, so they have a durable product in structurally growing markets. But here's where it gets really interesting for me. How they defend this incredible turf.
Yes.
Their primary defense mechanism is what we call the catalog moat, and it's combined with these near-crippling switching costs for their customers.
It's a definition of scale and scope. TI boasts the industry's most expansive portfolio, offering something like over 80,000 different products.
80,000, it's staggering.
It is. They dominate the long tail of low-volume, highly specialized parts that every engineer needs, but which, no rival really wants to dedicate specialized, expensive manufacturing capacity toward.
Let's really dig into the switching costs, because this is the critical insight for understanding the quality of this business.
Let's do it.
Imagine a high-end scenario. An engineer is designing a state-of-the-art, maybe $100,000 piece of medical imaging equipment.
Okay.
That machine needs hundreds of components, right?
Mm-hmm.
And that includes a tiny, functionally specific TI operational amplifier or a power regulator that might cost TI maybe 50 cents to manufacture.
A 50-cent chip in a $100,000 machine.
Exactly. Now, once that 50-cent TI chip is chosen, it gets designed into the circuit board. Then it's rigorously tested for performance and safety, a process that can take months, sometimes even years.
And it has to be qualified for stringent regulatory compliance, especially in medical or automotive, think FDA or FAA, and then it's integrated deeply into the software stack.
So now, imagine a rival company comes along and approaches that engineer. They offer a technically similar chip for 40 cents, a 10-cent savings.
The engineer's going to laugh them out of the room.
Almost universally, they'll say no. Why? Because the cost to redesign the entire board, to rerun all the regulatory testing, to requalify the supply chain, and to delay the product launch, all to save 10 cents on a half-dollar component.
It's completely prohibitive. The engineering time and the risk, it just far, far outweighs any potential savings.
So TI isn't just selling a piece of silicon.
No, they are selling reliability and qualification. They dominate the small chips that carry catastrophic risk if they fail. This creates an enormous sticky lock-in effect. It establishes TI as the essential utility provider for the entire electronics world.
And the cultural lock-in seems to reinforce the structural one. We've looked at the scuttlebutt, talking to engineers in the field.
What do they say?
They don't praise TI for being the flashiest or the fastest. They praise them for their legendary reliability, their meticulously detailed documentation, and their TI E2E support forums, which are known across the industry as the best in the business.
And the key hook, the thing that gets them early, is their extensive reference design library.
Tell us about that.
This library contains pre-engineered schematics and proven component lists for thousands of common applications. So an engineer can rapidly start a new project using a reliable TI reference design.
Which means they are locked into the TI ecosystem from day one.
From the very first day. They make the engineer's job easy, and that trust and convenience are worth far more than a 10% discount from a lesser-known competitor.
This inherent stickiness, this customer capture, it brings us to one of the most brilliant, really counterintuitive aspects of their entire strategy.
Inverting Moore's law.
Exactly.
This is pure intellectual jujitsu. Most of the semiconductor industry is stuck in this desperate, expensive race, chasing Moore's law. They're trying to shrink transistors to 5 nanometers, 3 nanometers.
Which requires massive, continuous R&D spending and results in products that often have an 18-month shelf life. It's a brutal cycle.
It drives competitive chaos, price volatility, and massive capital expenditures that often yield diminishing returns over time.
TI does the complete opposite. They deliberately, consciously step out of that race.
They focus on trailing-edge, technology-mature nodes, typically ranging from 45 nanometers all the way down to 130 nanometers.
And the advantage there is profound, isn't it?
It's profound. Because this technology is decades old, the manufacturing equipment needed to produce these chips is fully depreciated.
Meaning their internal cost of production is already incredibly low.
Rock bottom. Furthermore, the product life cycles span decades, not months. You might find a TI chip from the 1990s still in production today, being used in industrial systems that are expected to run for another 30 years.
So they optimize for longevity, stability, and profitability,
Right.
rather than speed and size.
They win by choosing the market where the rules favor stability and cost control. It's a different game.
And here's the core thesis of the current investment cycle. This is the big bet. They are taking that reliable, mature product focus and combining it with a bleeding-edge manufacturing scale.
Yes, this is the 300 millimeter manufacturing scale advantage, and it is the structural fortress widening in real time.
This is the driving force behind that $5 billion a year CapEx strategy we mentioned at the top.
That's right. TI is aggressively building and bringing online these massive new 300 millimeter wafer fabrication plants, or Fabs, while nearly all of their analog competitors are stuck on older, smaller 200 millimeter technology.
We need to spend a moment on the technical mechanics here because that 40% cost savings figure, it sounds almost hyperbolic.
It does, but it's rooted in simple geometry and scale. A 300 millimeter wafer has 2.25 times the surface area of a 200 millimeter wafer. Simple enough.
But it's not just a 2.25x increase in chips, is it?
Not at all. Because the chips are analog and they require these mature nodes, the yield, that's the number of usable, non-defective chips per wafer, is substantially higher on a 300 millimeter wafer than what you'd expect based on area alone.
So you get a disproportionately higher number of usable chips, what they call die per wafer, from the 300 millimeter size.
Right. Plus, when you factor in the fixed costs of processing a single wafer, things like labor, utilities, chemicals, those costs don't scale linearly with this size.
It doesn't cost 2.25 times more to process the bigger wafer.
Not even close. So the result is a structural cost reduction per chip of up to 40% compared to a peer still using the old 200 millimeter standard.
And that 40% cost reduction isn't temporary. It's not a one-time thing.
It is permanent and it is structural. That is their ultimate weapon. It gives them inherent pricing power.
So they can drop prices to crush smaller rivals if they have to.
Or they can just maintain prices and watch their own operating margins soar. It creates this massive self-reinforcing advantage over every other rival.
This positioning effectively makes TI the Walmart of the analog world.
That's a great analogy. They prioritize massive capacity, ultra efficiency, and huge volume at the absolute lowest cost.
And this contrasts sharply with their primary high-end rival, right?
Yeah.
Analog devices or ADI.
Oh, completely. ADI acts more like the Nordstrom. They often focus on highly specialized, high-performance, lower-volume chips used in things like advanced aerospace or cutting-edge medical applications.
They chase the specialty niches.
Exactly. TI, with its scale, is built to service the thousands of small and large clients, profitably selling tens of thousands of different chips. It's something rivals simply cannot match because of their inherently higher 200 millimeter structural cost base.
And connecting the scale and this long-term focus is the corporate culture. It's a crucial component of the moat that I think often gets overlooked.
It's described internally and externally as cult-like discipline and, frankly, extreme frugality. This is not the stereotypical free food, beanbags, and endless perks environment you'd find at a Google or a Meta.
No free lunch.
No free lunch. It is ruthlessly aligned with long-term manufacturing efficiency and zero tolerance for waste.
But doesn't that sink or swing culture create risks of its own? I mean, if TI is known for this extreme financial discipline and frugality, are they really attracting the best global engineering talent? The kind of talent who want those perks and higher base pay?
That's a fair question.
Or are they driving away the top-tier R&D professionals who might look at a capital-light competitor like ADI or maybe a specialized digital firm?
That is a legitimate challenge, and it's one they've thought about. Their culture attracts a very specific type of engineer and manager, one who values stability, long-term financial reward, and operational excellence over, say, rapid, volatile stock option growth.
And the incentives are aligned with that long-term view.
They are. The incentives are aligned with ownership. Employee sentiment, when you look at it, often highlights the stability and the extremely generous profit-sharing plans. This reinforces alignment with that 10 to 20-year performance window, ensuring that the frugality serves the long-term goal. It's a culture built for capital efficiency, not necessarily for innovation speed.
That distinction, efficiency versus speed, that brings us perfectly to pillar number 2. Management stewardship and financial resilience. Because even the best business model in the world can be destroyed by poor capital allocation.
And with TI, the capital allocation starts with an obsession over a single metric. It's a metric we consider the holy grail of shareholder alignment.
Free cash flow per share growth.
That's the one. The current CEO, Haviv Ilan, he's continuing the legacy established by Rich Templeton. They speak the language of owners, consistently communicating in 10 to 20-year time horizons, not quarter to quarter.
The genius of their compensation structure is what they exclude, isn't it?
That's the key insight. Management is absolutely not compensated based on easily manipulated metrics like simple revenue growth or even GAAP earnings per share.
Both of which can be gamed pretty easily in the short term.
Very easily. By tying incentives strictly to the growth of free cash flow per share, they ensure that every strategic decision, especially this high CapEx decision, is made with the actual cash generation benefit to the shareholder in mind, years and years down the line.
This focus results in a highly rational and, importantly, predictable capital allocation track record. And it's structured into 3 very clear priorities.
Priority number 1, organic growth. This is R&D and CapEx, which is currently the massive 300mm fab build-out. They prioritize internal high-return investments first, always.
Priority number 2, consistent dividends. TI boasts a remarkable track record of over 20 consecutive years of dividend growth,
which cements their reputation as a bedrock dividend payer. It appeals strongly to income-focused investors, and it acts as a core component of the total return proposition.
And priority number 3, aggressive buybacks.
But only when the price is right. They only deploy capital into buybacks when they view their own stock as undervalued. They use it as an opportunistic tool to enhance FCF per share.
And they have been incredibly effective at it. They've reduced their share count by nearly 50% since 2004.
Think about that. They've essentially doubled every remaining shareholder's proportional claim on the entire business over that period. It's an incredible return of capital.
This discipline stands in such stark contrast to so much of the industry. You see TI largely avoiding the splashy, expensive, and often value-destroying M&A that plagues their competitors.
Absolutely. We saw analog devices by maxima dilutive, complicated, and risky integration. TI prefers the slow, painful route, building their own high-return fabs in-house.
Because they believe, and I think rightly, that this yields demonstrably higher long-term returns on capital than paying a huge premium for someone else's assets and then incurring all that integration risk.
This whole philosophy results in undeniable financial fortress quality. Their profitability is just machine-like and consistent.
Historically, their gross margins sit consistently between 60 and 65%, and operating margins are perpetually in the 40 to 50% range. That's the definition of operational efficiency in a manufacturing business.
And their cash quality is superb. Historically, their FCF conversion ratio, that's the amount of reported net income that actually translates into tangible free cash flow, is nearly 100%.
Which is a sign of a truly high-quality business generating real, deployable cash, not just, ephemeral accounting profits that are tied up in receivables or inventory.
However, this brings us to the elephant in the room. It's the one thing that every investor has to reconcile right now.
The current return on invested capital, or ROIC dilemma.
Exactly. Historically, TI's ROIC was breathtakingly high. It was floating comfortably in the 30 to 40% range. That is world-class capital efficiency.
But if you check the financials today, ROIC is significantly depressed. It's sitting around 16 to 17%.
It's a huge drop.
It is. So it looks like they're trading that high-flying performance for bulletproof reliability, as we said, but the stock is often still priced for that 30% ROIC. So what does this massive dip mean? Is the business fundamentally broken?
No, absolutely not. The dip is not a sign of broken economics. It is the direct accounting consequence of this massive front-loaded capital investment cycle.
Okay, we need to walk through the accounting mechanics here carefully.
Let's do it. Let's break down the ratio. ROIC is net operating profit divided by invested capital.
The numerator and the denominator.
Right. When TI spends that $5 billion a year to build a new fab, those funds immediately become assets on the balance sheet. They are added to the denominator, invested capital, right now, today.
But crucially, the revenue, the profit, and the operating income, the numerator of that ROIC ratio from those new plants, that won't start coming online and being recognized until 2026, 2027, or even later.
So you are jacking up the denominator immediately, year after year, but the numerator takes years to catch up.
This artificially and mechanically depresses the ROIC ratio for several years.
It has to. The whole thesis relies on the prediction that once those fabs are fully operational and utilized, the numerator will explode upwards, driving the ROIC back toward its historical 30+% levels and validating the entire investment.
And we can see the impact of this commitment on the balance sheet, too.
We can. While it's still financially prudent by any measure, their net debt to EBITDA is currently around 1.1 times.
Historically, TI often operated with a massive net cash position on its balance sheet.
A huge cash pile. The slight increase in debt is directly attributable to the borrowing needed to finance this massive multi-year factory build-out. It's manageable debt, but it is a noticeable shift in their conservative financial stance that demands ongoing monitoring.
That brings us perfectly to pillar number 3, valuation, risks, and catalysts. Because even the most durable fortress in the world can be a terrible investment if you pay too high a price for it.
The first thing you have to acknowledge is the premium. TI typically trades at a substantial premium consistently in the 20 to 25 times price to earnings range. And that's relative to the broader, often much more volatile semiconductor index.
So why do we pay that premium? What are you getting for that?
You are paying for certainty. You're paying for stability and durability. You are paying for gold standard capital allocation, decades-long product life cycles, and very low obsolescence risk. You're paying for a business that generates machine-like cash flow.
So the expectation for returns is structurally lower than, say, a high-growth SaaS company or a digital chip stock, but it's far more certain.
Far more certain. So assuming the valuation multiple remains stable, your returns will closely mirror the growth in free cash flow per share, historically around 10 to 12%, plus the dividend yield, which is currently around 3%.
But if an investor pays, say, 30 times earnings, they're guaranteeing a significant compression of that multiple eventually, which would dramatically reduce their total yield.
That's the risk.
So if TI is never truly cheap in the classic sense, where do you find the margin of safety?
You find it in cycle timing. The margin of safety is not a low valuation multiple. It's having the stomach to buy during the downturns when the short-term numbers look absolutely horrific.
Like right now.
We saw the best opportunity during the industrial inventory correction of 2023 and 2024. That is when customers stop ordering new chips to burn through their existing stock.
So TI's revenues temporarily decline and their lead times shrink. That's when the news flow is all negative and the short sellers are circling.
Right. Buying a cyclical, durable business during the boom when revenue is surging and everyone is euphoric is the surest way to lock in poor returns. The goal is to buy the factory capacity expansion at the low point of the demand cycle.
Now, let's talk about the primary growth engine, because this really underpins the entire CapEx gamble.
It does, and it is crucial to understand that their growth is not dependent on global macroeconomic unit volume growth. It is dependent on content growth per unit.
This is such a critical distinction. Let's use the automotive sector as an example. Even if global car sales stagnate at their current levels for the next decade,
the dollar amount of TI content, the sheer number of analog, power management, and embedded chips inside each new vehicle is skyrocketing.
Driven by the mass adoption of electric vehicles and advanced driver assistance systems, or ADAS.
The transition from a mechanically controlled internal combustion engine to an electronically controlled EV requires a fundamental shift in componentry. And that shift largely benefits analog and power management specialists like TI.
And the same principle applies relentlessly in the industrial sector, right?
Relentlessly. Every single time a factory upgrades its automation level, the content required per industrial robot, per sensor, or per machine tool explodes upwards. This ensures a structural headwind of demand irrespective of macroeconomic fluctuations.
But every great investment thesis must be tempered by its permanent impairment risks. The things that could fundamentally break the bull case and prevent that ROIC from ever returning to 30%.
The first, and arguably the largest, is the geopolitical China threat. China is currently TI's single largest market.
And the risk is structural domestication.
Precisely. Analog chips, especially the mature, high-volume commodity parts that TI specializes in, are substantially easier for a state-subsidized rival to replicate than cutting-edge digital logic.
It's a much lower technological hurdle to clear.
Much lower. So if the Chinese government successfully subsidizes and executes a domestic analog supply chain strategy to replace TI's low-end, high-volume products, TI could permanently lose 20 to 30% of its revenue base, and they'd have very limited ability to regain it.
That is an existential threat that money and operational efficiency cannot fully solve on their own.
It's a pure geopolitical risk. The second major impairment risk is the high-stakes CapEx gamble itself. We keep circling back to that $5 billion per year expenditure.
Because it's everything.
It is. If the underlying structural demand, that massive content growth in auto and industrial, if that fails to materialize between 2026 and 2030, or if TI simply fails spectacularly on the execution,
They will be left with colossal depreciation costs and idle, expensive factories.
and those underutilized assets would immediately crush their operational leverage and structurally lower their previously exceptional 40 to 50% operating margins. The entire financial profile of the company would fundamentally change.
And the argument for that premium valuation would just evaporate.
This is the financial risk that the management team is placing their entire legacy on.
However, there are powerful potential catalysts on the other side that could accelerate the realization of the fortress and surprise the market to the upside.
The most immediate catalyst is the cycle turn. We are currently experiencing a painful, drawn-out inventory correction.
So a macro-level return to restocking among industrial and automotive customers,
Yeah.
which market watchers expect roughly late 2025 or 2026 would immediately reverse the current revenue declines.
And lead to soaring utilization rates in their existing older fabs, even before the new ones are fully ramped.
And the other major financial catalyst is government support, the GHPS Act.
The receipt of U.S. CPS Act funding, yeah. TI is building these massive new factories in places like Sherman, Texas, and Lehi, Utah, which require enormous upfront capital.
So receiving significant government grants for this construction would immediately lower the effective capital expenditure required.
And critically, it would lower the long-term cost basis of their new 300mm capacity. This directly enhances the potential ROIC of the entire project.
So this is where we need to engage in some deep second-level thinking. The market consensus right now is fixated on the negative. It's TI is losing share and spending too much money on factories during a downturn.
That's the headline. But the contrarian deep dive insight is that they are intelligently leveraging the downturn. They are sacrificing current FCF precisely to build an unassailable future cost advantage.
They're building this 300mm capacity during a lull when construction costs and equipment access are potentially more favorable.
Exactly. And when these fabs come fully online and are utilized between 2026 and 2030, that structural 40% cost advantage will kick in, and the free cash flow per share growth will accelerate dramatically, catching a market by surprise that was focused only on the short-term margin drag.
That brings us perfectly to pillar number 4, the final synthesis. This is where we summarize the core conflict and present the strongest possible counterargument to the entire long-term thesis.
Let's start with the investment thesis, the fundamental bull case for owning TI. It's really built on 3 legs: durability, structural cost, and management discipline.
Okay, first, durability. Analog chips are like the flour and sugar of the digital age. They're essential ingredients that are basically immune to obsolescence risk. They are not going anywhere.
Second, the cost advantage. The 300mm manufacturing strategy is the ultimate moat builder. Once it's fully ramped, it will lock in a structural cost advantage, that 40% difference that even their largest rivals on older 200mm equipment cannot possibly match.
They achieve an efficiency of scale that is nearly unassailable.
And third, management. Their capital allocation policy, centered so fiercely on FCF per share growth, remains the absolute gold standard for long-term shareholder alignment. They think like owners, prioritizing long-term value over short-term revenue spikes.
Okay, so that's the bull case. Now let's look at the bear case. The counter thesis, the risks that could lead to permanent capital impairment.
Geopolitical risk is paramount. The possibility of China successfully executing a mass substitution of TI's analog parts remains a structural and, frankly, existential threat to a significant chunk of their revenue base.
Second, the financial drag. The margin compression from factory depreciation, it's real, and it will weigh on financial performance and keep that critical ROIC metric depressed for several more years.
Investors require patience and a lot of conviction to wait out this period of artificial underperformance.
And finally, price risk. Because the stock is consistently priced for perfection, it's a quality business that everyone knows is quality, it leaves virtually no margin for error.
Right. If growth slows materially, or if the factory ramp-up fails to deliver those promised 40% efficiency gains, the valuation multiple will contract painfully.
Which would lead to poor returns even if the business itself remains structurally sound.
This leads us directly to the red team challenge. This is the final, most powerful argument against TI's heavy manufacturing strategy. We call it, intentionally, the Intel trap argument.
The core question is this. Is TI, in its relentless pursuit of cost control through owned assets, repeating the historical strategic mistake of Intel by doubling down on the integrated device manufacturer, or IDM, model?
In a world that is shifting rapidly toward capital-light specialization.
Exactly. We have to look at the historical parallel. Intel's mistake was betting the farm on its internal IDM structure and its own proprietary process technology. They refused to embrace the specialized foundry model.
And when foundries like TSMC surpassed Intel in process capability, Intel was left with massive, costly, and rapidly obsolescing assets. They became anchors rather than sales.
So contrast TI's high CapEx approach with their primary rival, analog devices. ADI is increasingly utilizing capital-light, advanced foundries like TSMC for its production.
ADI does not have to spend $5 billion a year on fabs. This allows them to remain structurally nimble. It lets them potentially retain higher margins on invested capital by avoiding that massive depreciation load.
So if the foundries, and this is the key risk, if they can eventually offer equal or even better analog technology and manufacturing capability with a significantly lower capital intensity requirement,
then TI's multi-billion-dollar heavy-owned assets could become an anchor. They could suddenly find themselves structurally disadvantaged in terms of ROIC.
the risk is structural change. If TI's heavy assets become obsolete or underutilized due to external foundry advances or their own field execution, they face the risk of structurally lower ROIC, permanently stuck at that 15% range instead of their historical 30 to 40%.
The central question is that 40% cost advantage truly permanent and defensible, or can the foundry model eventually erase it by offering a better capital structure?
So, synthesizing everything we've discussed, Texas Instruments presents a classic dilemma for the long-term investor. It is a fundamentally wonderful, exceptionally durable business, perhaps one of the most reliable in the entire semiconductor space.
But it is priced for perfection, and its future performance hinges entirely on the successful execution of this aggressive, high-stakes manufacturing gamble.
Exactly. The next 3 to 5 years are the most important in their recent history. The outcome depends entirely on whether those new 300mm fabs come online on time, ramp up successfully, and realize that projected 40% cost advantage.
Making the current financial drag a temporary, rational sacrifice.
That's the bet.
Let me leave you with one final provocative thought that ties back to the China risk and that utility provider concept we talked about. The world is clearly moving toward a geopolitical landscape of fragmented, localized, and resilient supply chains. It's a pronounced trend away from decades of pure globalization and centralized efficiency.
Does TI's core advantage, which is centralized, massive-scale, 300mm manufacturing designed for maximum global efficiency, does that become a geopolitical liability in a world that's prioritizing redundant, localized supply and national security control over the source of critical components?
ROI is the inherent crushing cost efficiency of that 300mm scale, the only thing that can protect their operating margins and allow them to compete successfully and profitably during the next decade of structural localization and supply chain fragmentation.
That is something for you to continue exploring as you watch this fascinating story unfold. A truly fascinating dilemma in capital allocation. We appreciate you joining us for this deep dive into Texas Instruments.
Thank you for tuning in. We'll see you next time.